Wei, please assist on the nuance to change here as you look mid-year to the rest of the year.
Absolutely. So we're releasing our second half of the year outlook today. And the main theme here is really that we are in a regime change, that the great moderation of the past 4 decades characterized by steadily growing production and the environment driven by supply. Well, that is now over because we're now in an environment, the environment driven by demand was over because we're now in an environment driven by supply. And that means actually the trade-off between growth and inflation is so much tougher, and whichever way central banks act, either to live with inflation or to fight inflation by hurting growth, we're going to be looking at a worse set of outcome for growth and inflation. And that is also why through the course of this year, we have been incrementally reducing portfolio level risk taking. And at this juncture, we reduce portfolio level risk further. And in this moment, we're actually applying a up in quality adjustment to portfolio by downgrading developed market equities further into underweight and upgrading investment grade into overweight at this juncture.
So Wei Li, talk to me about the future then and the characteristics of this new market regime, given everything you've just said. Is it lower returns and higher volatility as far as the eye can see? Is that the way you're thinking about things beyond this year, into next year and after that?
Well, in this new regime, when it comes to investment, I think the most important implication to remember is that the Goldilocks outcome is now off the table. The Goldilocks outcome whereby you have sustained and joint bull markets in equities and bonds, which is very much what characterized recent decades. Well, that is now off the table. And when it comes to portfolio construction, we're talking about higher risk premium for equities and bonds. We're talking about no automatic buy the dip. We're talking about re-evaluating risk models calibrated to history. And we're also talking about being more dynamic when it comes to adjusting portfolios, right? Because cycles are becoming shorter, macro volatility is higher, and market volatility is higher as well. So I just mentioned the adjustment that we're making, downgrading developed market equities and upgrading global IG investment grade. But we do not expect to hold it for an extended period of time. When we would exit this bear market, when we would become more positive, actually there's a super big call that we're very, very focused on, and we're signposting that explicitly in the outlook as well.